Well, the sales market has definitely slowed down, and the reason it's slowed down is because there's a lot of uncertainty in the market, and I think there's a lot of question around valuations. So JLL's data shows that about 60% of volumes are down year over year, which is quite significant. But the transaction volume is still very high, specifically in the credit space and the pref equity space. And we think that there's going to continue to be a lot of transaction volume within those categories. And eventually the sales transaction volume will catch up. But for the time being, there is going to be less sales, more focus on strategic recaps and credit and pref equity instruments. What I would say is borrowers are now, or capital is now looking 12 to 18 months out on what they want to do versus 6 to 12 months before. So everybody is trying to get smart around what ultimately they are going to do and how they are going to transact. But a sale right now is probably the last focus for anybody. It's going to be more focused on how can I use debt, or how can I use a pref equity or even a recap instrument to try to create some sort of liquidity in the current market. Well, I think recaps are going to prove that there is liquidity out there at the right levels and at the right cost and for the right assets and the right sponsors. I think recaps are also going to buy people time. Ultimately, people right now need time to try to get through the volatility in the market. And ultimately, if they're not getting the levels of values for wanting to sell, they're going to need to buy some time because a refinancing is likely coming due, or some sort of capital event is likely coming due. So by having these recaps, either with debt or equity, it's going to buy borrowers and platforms time to execute their business plan, where they may have been thinking about exiting now, but need another 12 to 24 months to work through their business plan that could be delayed for multiple different reasons, other than it just being not the right time to exit. Well, rising interest rates, which is out of everybody's control, is a challenge, and it continues to be a challenge. I think the uncertainty in the market is the biggest challenge. I mean, even if there is certainty and it's negative, at least people have a pretty clear view on where we're going. I think there is a lot of cloudiness and there's a lot of unknown in the current market, which creates a lot of issues, and it creates people to kind of take a step back because they don't really want to have to do something if they don't have to. And if you're in a market, even again, if it's negative, you kind of know where we're headed. I think there's still a lot of unknown on where we're headed. And that is the biggest difficulty in the market, is people are not quite sure what to do, which forces a lot of people to pause. But loan maturities don't pause. And loan maturities are going to be the biggest driver to forcing some sort of recapitalization or transaction event in the current market. Well, I think there's a lot of opportunity in the structured recap credit space. I think historically the market for a long time was a borrower's market when you had really low cost of debt and borrowers were able to take advantage of that. It is now a lender's market. Lenders, just where rates are, can get a significantly better return for the same risk that they essentially were taking. So if you look at the credit space, there's going to be an abundance of liquidity coming from all sorts of different capital. Not only your traditional banks, insurance companies, debt funds, but you're also talking about the sovereign wealth funds, you're talking about equity asset managers, you're talking about all of these groups that want to deploy capital, but because no sales are happening, they can't do it the traditional way. So they have to do it the more structured way, and getting creative around pref equity structures or convertible mortgages or whatever sort of structured solution that releases capital for the underlying borrower. And I think that's a really interesting time for capital out there to be able to deploy capital at a significantly de-risked position, but still getting the same type of returns that they would get within the equity space historically. Well, I think logistics and living will continue to be the most attractive sectors. I do think alternatives like self-storage and life sciences have been a huge beneficiary of what's going on, specifically self-storage, because it is linked to inflation and it's a good hedge to inflation, as real estate generally is, but self-storage specifically is. And if you look at the supply and demand imbalance of self-storage in Europe in comparison to the US or in comparison to Australia, which are the two most mature markets, there is a huge runway for self-storage to continue to develop. It's just going to have to be done through construction and development, which takes time. And ultimately, you can't just build self-storage and stabilize it within 9 to 12 months like you can with logistics. It takes several years. But if you look at just self-storage as an asset class where yields are, and where you're seeing build to rent, and where you're seeing people want to use space, and instead of getting a 3-bedroom, you get a 2-bedroom, and then you go and you rent storage and you use storage as your 3rd bedroom. People are getting more creative with the way that they're using self-storage. So I think self-storage is going to be one of the asset classes that is going to come out of the current environment extremely in high demand for investors in Europe. But I think living and logistics and even life sciences will continue to be the asset classes that people focus on right now. Well, Spain in Southern Europe has been a huge focus for us this year specifically. We've seen a lot of transaction volume happening in Spain, specifically in the living sector. But I think France, I think the Nordics, I think any market that traditionally was very insulated with local owners and local lenders is now going to become more ripe for international capital. And I think there's going to be a lot of international capital looking at markets that they historically have not been able to get into because, again, they've been so insulated by domestic capital. And Spain has been the leader of that. I think you're going to see that leak over to France and Germany and the Nordics as well. And there's really not a market in Western Europe specifically that we see as a market that people aren't going to have interest in. But Spain and Germany and France are probably the 3 markets that we think are going to be the most attractive for international non-domestic capital groups. Well, I think the demand's going to be there. It's lining up the demand with expectations of sellers, right? If you can align the liquidity with the expectations of the current ownership market, then you're going to have a lot of transactions. There continues to be this bid-ask gap in terms of expectations and returns and where people are willing to buy something versus where people are willing to sell something. So I think in the short term, there's going to continue to be that bid-ask gap, but there continues to be more dry powder globally focused on commercial real estate than there ever has been. And that dry powder, has to go somewhere eventually. And right now it's focused on going in the credit space. And so people are going to continue to get smarter on how they can structure deals within the credit space and put out deals within the credit space. And that's going to be probably the focus for the next 6 to 12 months, or for however long it takes for the sales market to reset and there be equity opportunities out there that, again, align with what sellers and buyers want to do. But until then, it's going to be focused primarily on credit solutions and structured equity credit solutions. Clarity. I hope everybody has the same view, which would give not only me, but I think the market a lot of comfort. I think to my earlier point, when you have a lot of different views and a lot of different thoughts on where we are going and what's going to happen, and they tend to contradict each other, it creates nervousness in the market. And nervousness is not what we want in the market. Again, even if the sentiment is negative, if it's consistent, right, that nervousness will go away because everybody will understand where we are and where we're going and how do we get there and what is the right thing to do. When you have a bunch of smart people in the room and everybody has a different view on what is going to happen, it creates confusion and it creates uncertainty and it creates nervousness. So hopefully we're getting to the point in the cycle in the market where we can have some conviction around all of the panelists in the group, where we have a message to the market on where we're headed. The market may like it or not like it, but as long as it's consistent, I think that would be a great outcome for GRI.